For decades, private equity reigned as the ultimate wealth machine. Brilliant dealmakers turned struggling companies into cash machines, leveraging debt to generate staggering returns. Fueled by cheap capital, aggressive takeovers, and financial engineering, the industry thrived. But today, cracks are forming. Interest rates have soared, competition is fiercer than ever, and the once reliable leveraged buyout (LBO) model is struggling to deliver the same outsized gains. Some say the golden age of private equity is over. To understand how we got here, we must first examine how this empire was built. The modern private equity industry emerged in the 1980s, driven by the rise of LBOs. Instead of using their own money to buy companies, firms used borrowed capital, sometimes financing up to 90% of the purchase price with debt secured against the company's assets and cash flow. The logic was simple. If the company's profits grew, the return on the initial investment would be exponentially magnified. This strategy worked like a financial amplifier. Private equity firms would acquire a company, immediately streamline operations, and use earnings to pay down debt. If all went according to plan, they could sell or take the company public at a much higher valuation, often generating returns of 10, 20, or even 30 times the initial investment. For decades, this formula proved to be a dominant force in finance. The right mix of leverage, operational expertise, and aggressive deal-making made it seem as though almost any company could be turned into a success story. A handful of visionaries turned private equity into a financial powerhouse. Henry Kravis and George Roberts of KKR were among the earliest LBO pioneers, building a reputation for ruthless deal-making. Their crowning achievement came in 1988 with the $31 billion buyout of RJR Nabisco. The RJR Nabisco buyout in 1988 became the defining deal of the LBO era, a ruthless bidding war that pushed financial engineering to its limits. A high-stakes corporate battle immortalized in Barbarians at the Gate.
They all said they tasted like shit.
Like shit?
Shit was the consensus, yes, sir.
They all said that? Nobody?
KKR's victory showcased both the brilliance and excesses of private equity. The Hilton Hotel's acquisition in 2007 was another milestone. Blackstone bet $26 billion on the hospitality industry just before the financial crisis. Yet, through strategic improvements, they turned it into one of the most successful private equity deals of all time. Schwarzman built Blackstone into the largest alternative investment firm in the world. One of his most legendary deals was the 2007 buyout of Hilton Hotels. Despite the looming financial crisis, Blackstone held on, improved operations, and eventually exited with $14 billion in profit. David Rubenstein of the Carlyle Group focused on acquiring government and defense-related companies, securing lucrative contracts, and capitalizing on steady cash flows. His strategy helped Carlyle become one of the most influential private equity firms of the modern era. Each of these men built more than just firms. They built empires that reshaped entire industries and transformed the financial landscape. But not every LBO was a triumph. The buyout of TXU Energy in 2007, a $45 billion deal led by KKR, TPG, and Goldman Sachs, became a disaster. The firm's miscalculated energy prices overloaded the company with debt and ultimately saw it collapse into bankruptcy, proving that leverage could amplify both success and failure. For a while, for years, private equity thrived under near-perfect conditions. Debt was cheap, lenders were eager, and public markets were strong. making it easy to exit investments through IPOs or strategic sales. Most importantly, private equity firms had little competition, allowing them to dictate terms and maximize returns. As long as these conditions held, the LBO machine kept printing money.
If money is evil, then that building is hell. This is the most obnoxious group of money-hungry, low IQ, high-energy jackrabbit.
Today, private equity is facing a new reality. The cost of capital has skyrocketed. Interest rates have risen sharply, making debt far more expensive. Loans that once carried interest rates of 4 to 5% now demand 9 to 12%, cutting deeply into profit margins. Lenders have tightened credit conditions, forcing private equity firms to contribute more equity to deals, which dilutes returns. At the same time, competition has reached an all-time high. With trillions of dollars in dry powder, private equity firms are all chasing the same assets, driving up acquisition prices and reducing upside potential. The industry has become increasingly commoditized, with firms relying on similar strategies like roll-ups, digital transformation, and cost-cutting. The days of finding hidden gems are fading fast. Exits are also becoming far more challenging. The IPO market has weakened, corporate buyers are hesitant, and secondary buyouts, where one private equity firm sells a company to another, have become less attractive as inflated entry prices leave little room for profit. Many firms are now stuck holding onto assets for longer than expected, tying up capital and lowering internal rates of return. Private equity firms are also facing mounting pressure from their investors. Pension funds, endowments, and other institutional backers, once eager to allocate capital to private equity, are now facing liquidity constraints. As public markets have declined, many investors have found themselves overexposed to private equity, making them hesitant to commit fresh capital. Some are even offloading their private equity stakes in the secondary market, often at discounts, just to free up cash. Meanwhile, governments and regulators are cracking down. For years, private equity thrived in a lightly regulated environment, using tax loopholes and aggressive financial strategies to maximize returns. But that is changing. Policymakers are eyeing higher capital gains taxes and the closing of carried interest loopholes, which could significantly impact partner compensation.
The biggest one was President Trump telling Republicans in that meeting that he would eliminate the carried interest loophole that allows private equity, venture capital, and hedge fund managers to pay a lower rate on part of their earnings. Now,
increased scrutiny of large acquisitions is making it harder to execute roll-up strategies, while new labor protections are restricting traditional cost-cutting measures. Private equity is also facing new competition from other asset classes. Private credit, offering high single-digit or even double-digit yields, has become an attractive alternative for institutional investors looking for strong returns without the risks of leveraged buyouts. Infrastructure, energy, and real estate investments are also drawing capital as investors seek stability in an uncertain economic environment. And with rising interest rates, high-growth technology investments, which powered private equity's best years, are no longer as appealing. The private equity model, once so reliable, is facing its toughest test yet. Rising interest rates, fierce competition, constrained exit opportunities, investor pushback, regulatory scrutiny, and shifting market dynamics have all combined to create a far more challenging environment. This isn't the end of private equity. Far from it. But the easy money is gone. The firms that will thrive in this new era will be the ones that adapt. Those that can generate real operational improvements rather than relying on financial engineering. Those that can find proprietary deal flow in a world of intense competition. And those that can navigate a far more complex, unpredictable landscape. The next decade will separate the great firms from the merely good. And in private equity, merely good is no longer good enough.